Hey everyone, it's Madhur and welcome back to the channel. Today we're diving deep into the world of global finance to answer a question that's been on my mind a lot lately. Why do countries invest in gold? It might seem a little old school in our digital age, but trust me, there are some seriously compelling reasons why governments around the world still hold on to these shiny reserves. We're talking about economic stability, crisis protection, and the long game of international finance. Stick around, because by the end of this video, you'll understand exactly why gold remains a cornerstone of national wealth strategies. Okay, let's get right into it. First and foremost, gold has served as a reliable store of value for centuries. Think about it. Currencies fluctuate, stock markets crash, but gold has this incredible ability to hold its value over the long haul. Unlike fiat currencies, which can be printed endlessly and lose value through inflation, gold's supply is inherently limited. This scarcity is precisely why it's been so resilient, especially during times of economic uncertainty. Remember the financial crisis of 2008? While stock markets plummeted and people were panicking, guess what held strong? You got it, gold. It's like this safe haven, this tangible asset that people flock to when everything else seems shaky. And you know, as much as we love talking about the latest tech stocks and cryptocurrencies, there's something to be said about an asset that stood the test of time for literally thousands of years. Now, let's talk about diversification. Anyone into investing knows you don't put all your eggs in one basket, right? The same goes for countries managing their wealth. They need to diversify their foreign reserves, and gold plays a crucial role in that strategy. See, gold generally has a low correlation with other assets like stocks and bonds. This means that when the stock market is going crazy, gold might zig while everything else zags. This is huge for managing risk. By holding gold, countries can create a more balanced portfolio that's less susceptible to wild swings in the global market. If something happens to the value of the dollar, their entire reserve takes a hit. But if they've diversified with gold, they have a safety net. It's all about balance and risk management on a global scale. Let's talk about inflation for a second. You know that thing that makes your money worth less over time? Well, gold has historically been a fantastic hedge against inflation. See, when the prices of goods and services go up, the purchasing power of your money goes down. But gold tends to retain its value and often even appreciate during inflationary periods. Think about it. 100 years ago, you could buy a nice suit with an ounce of gold. Guess what? You can still buy a nice suit with an ounce of gold today. This is especially important for countries because they need to protect their national wealth from being eroded by inflation. By holding gold reserves, they're essentially safeguarding their purchasing power on the international stage. When a country's currency weakens significantly, gold acts as a buffer. Now, imagine a country facing a major crisis. It could be anything from a natural disaster to a political upheaval. Suddenly, they need access to funds, and they need them fast. This is where those gold reserves become absolutely critical. Gold is like a national emergency fund. It's a highly liquid asset, meaning it can be quickly and easily converted into cash when needed. Countries can sell a portion of their gold reserves to inject much-needed liquidity into their financial system. But it's not just about having readily available cash. Gold can also be used as collateral to secure international loans. Gold provides that tangible backing, that assurance that a country can meet its financial obligations, even during turbulent times. Let's talk about currency stability for a moment, because it's crucial for a country's economic well-being. When a currency is volatile, swinging up and down in value, it creates uncertainty and can undermine investor confidence. This is where gold comes into play as a stabilizing force. Central banks can actually use their gold reserves to influence the value of their currency. If a currency is depreciating too rapidly, they can sell some of their gold reserves, which increases demand for their currency and helps to prop up its value. It's a way to manage those wild swings and restore a sense of stability. The mere presence of significant gold reserves can act as a deterrent against currency speculation. It's like a psychological safety net that helps to instill confidence in the market. Gold is a big part of sending that message. Let's face it, the world of international finance can be pretty complex. Different currencies, different regulations, different levels of economic stability. But there's one thing that seems to transcend all those differences: gold. You see, gold is like this universally recognized and accepted asset. It's the ultimate form of global trust. It doesn't matter if you're in Asia, Europe, or North America, gold holds its value and is readily accepted in transactions. This global acceptance is crucial for facilitating international trade, especially in times of geopolitical uncertainty, when trust in traditional financial systems might be strained. Gold can act as a neutral intermediary. Countries can quickly convert their gold reserves into cash, providing them with the financial flexibility to navigate challenging economic conditions. All right, let's talk about one of the fundamental reasons why gold has maintained its value for centuries: its limited supply. Unlike fiat currencies, which can be printed endlessly, gold is a finite resource. There's only so much of it on Earth. This scarcity is key to understanding gold's enduring value. You see, the basic principles of supply and demand tell us that when something is scarce and in high demand, its price tends to go up. While there's still gold being mined, it's a slow and expensive process. New discoveries are becoming increasingly rare, and the cost of extraction is rising. This means that the supply of gold is not growing at a pace that can keep up with global demand. Its limited supply helps to ensure that its value remains relatively stable, even as the purchasing power of fiat currencies erodes over time. Now let's shift gears and talk about what's happening right now in the world of central banks. We're seeing a fascinating trend. Central banks around the world, especially in emerging economies, are gobbling up gold at a rate we haven't seen in decades. Take China, for example. They've been steadily increasing their gold reserves for years, and they're not alone. Russia, India, Turkey, they're all diversifying their reserves and adding more gold to the mix. So what's driving this trend? Well, there are a few key factors at play. First, there's growing concern about the long-term dominance of the US dollar as the world's reserve currency. As other economies grow in strength, they're looking for ways to reduce their dependence on the dollar, and gold provides a viable alternative. In times like these, countries want assets that are seen as safe and stable, and gold fits the bill perfectly. Central banks recognize that holding a basket of assets, including gold, is a prudent strategy for managing risk and ensuring long-term financial stability. For decades, the US dollar has reigned supreme as the world's reserve currency. But lately, cracks have begun to appear in that dominance. The global financial crisis of 2008, followed by years of quantitative easing and soaring government debt in the United States, has led some to question the dollar's long-term stability. This uncertainty surrounding the dollar's future has prompted many countries to diversify their reserves, and gold has emerged as a primary beneficiary of this shift. Gold is seen as a neutral asset, free from the political and economic baggage that comes with holding a single currency. As more countries seek to lessen their dependence on the dollar, we can expect to see continued demand for gold. It's a hedge against currency risk, a way for countries to diversify their holdings and protect themselves from potential volatility in the global financial system. Whether or not the dollar's reign is truly coming to an end is a topic for another video. So, there you have it, the key reasons why countries invest in gold. From its historical role as a store of value to its importance in modern portfolio diversification, gold continues to play a vital role in the global financial system. As we've seen, it's a hedge against inflation, a safe haven during crises, and a source of confidence in an increasingly uncertain world. Whether you're an individual investor or a country managing billions in reserves, understanding the role of gold can provide valuable insights into navigating the complexities of the global economy. Thanks for watching. If you found this video informative, don't forget to like, share, and subscribe for more insights into global financial strategy.